Hi, my name is Ray Adams, Chartered Financial Planner from CashCalc. Today we're going to look at the TVC and APTA tool, and I'm just going to take you through a very simple case study on how to use it. So as you can see on screen here, we've got the client dashboard. Now, it doesn't mean the client sees this, but this is where the advisor has logged into their own dashboard, selected their particular client they're working on, and you're now within that particular client. And you can see we've got the onboarding functionality, our core tools, going around to the TVC and APTA, and the center of all of this being their cash flow modeling tool. So this client, we've already previously sent them a data capture request, and this client has done us a fact find. So I'm going to go straight into the TVC. What you can do is, to help you as pension transfer specialists, we've put together an attitude to transfer risk questionnaire. This is just a guide for you to use. You may find it useful to have as an appendix to your fact find, or you might just want to use some of the ideas to make your own fact find a bit bigger. And it looks at what the basic level of income the client's looking for in retirement and also for their spouse. Looking to really add some color and detail here by saying what specific objectives you've got, and there's some thought-provoking things there for the client, because many clients might just say, oh, I'm looking for flexibility and I want to leave the children money. But actually, when they look at this and say, actually, I do want to do some renovations and go on holidays. So we're looking to get some costed objectives off the client. So when you come in and have a look at our tool, you might think, well, actually, I quite like some of these questions. This one, for example, I quite like here. Is this defined benefit pension essential spending, or is it completely surplus to your needs? What we're looking here is for the client to just put their own words in here. So moving on to the TVC and APTA tool, I'm going to go in there now and we're going to create a transfer value comparator. What we've tried to build here is something which is very intuitive, and what that means to me in normal money is it's obvious what you need to do. So on this page now, it's brought the basic information we know about the client, their date of birth, and their gender. And now hopefully you've got the cash equivalent transfer value, or CETV, in front of you, and you can start filling it in from that form. So I'm just going to put some basic information. This client's been in here, so let's say since, let's say, 1985, so there's going to be a pre-88 GMP. And when did the client leave? Well, they left then, say, 2015. So we've got 30 years service there. The data calculation could well be today's date or a few days ago if you've got the information from the CETV provider. Normal retirement age of the scheme, and also whether the client's got a different desired retirement age. I'm going to leave it for 65 a minute because I want to show you something, and then we're going to put the name of the scheme, so XYZ employer. And then important thing then, what's the cash equivalent transfer value? So in this case it's 250,000, and there's the option then to include pension commencement lump sum, PCLS, in it. And when you do it, was there a max PCLS, protected tax-free cash at A day, and there's the explanation. And if there isn't, just new rules apply. Again, I'm going to unclick that in a minute because I just want to possibly come back to that. So very, very simple inputs there. Next page are actually the benefits. So on the left-hand side, you can see there's the different type of benefits you can put in. So we got a bit of pre-88, we said, because they joined 85. So let's say, for example, that was £500. That was based on date of leaving. If it's statutory revaluation, it's already filled in 4.75 based on the date of leaving. And then the escalation in retirement, well, it's pre-88, so there's no escalation there. there is 5-year guarantee, 50% widows. So let's add another benefit. Now we've got a little bit of post 88. Let's say there's a bit more there. Again, date of leave-in, same statutory revaluation. This time, let's say it's RPI max 5. 5-year guarantee, 50 again. And let's say now, just to make it nice and easy, 6,750 there, so it's up to 8,000. Date of leave-in, again CPI reval, CPI escalation. Hopefully these inputs are fairly simple and obvious. So we've got there £8,000 benefits of date of leave-in with a bit of pre and post GMP and a bit of excess. You know, there is the option for bridging pensions as well, but I'm going to keep it nice and simple for you today. There's your death benefits as we put in. Again, hopefully that was nice and simple. Now, if you notice, there was no questions about early retirement or commutation factors. So if I go back to scheme information and say, well, actually in my case, the client wants to go at 60. So now at pension benefits page is saying, do you have the early retirement factors? Yeah, it's 5% reduction each year, and the earliest without penalty is 65. Basically, if the client takes it at 60, it's 5 years early, there's a 25% actuarial reduction. Again, there's nothing about tax-free cash. So if I go back and say we want to include PCLS, go back there, and now there's commutation factors. So we say it's 12 to 1 at 65 and 18 to 1 there, or whatever the scheme rules say, but I'm just making this nice and simple for us. If you've got some benefits which are, 60 retirement, you can just add a complete different group of benefits at the bottom here, and you might say this is the, retirement age 60 benefits or whatever. Okay, so you can have different tranches with different rules as well. So I'm going to keep it nice and simple for you today. So what we've done there, scheme information, benefits there, next button, there's your outputs. It's as simple as that. So what we've got here, you can see £8,000 of date of leave-in, revalued because they left a few years ago, approximately in today's value, and of course it is an approximation, but that's just trying to give the client and also the advisor a bit of a flavour of what these benefits are worth. I'm a pension transfer specialist, and quite often clients would say to me, look, my pension's only worth 5,000. Yeah, but that was a date of leave-in and you left 15 years ago. And revalued, that may be £10,000 in today's terms. Now that's a completely different pension to what they thought they had. So this is just to give the advisor and the client a flavour of what their pension is currently worth. And of course we've then projected that on, and in this case 10,674 at normal retirement date. Because we had a commutation factor, it's taken that into account. So for every £12 of lump sum they've taken, they've lost £1 of income. And there you go, so 45,000, just under 48,000, which would be a 4 to 1 ratio, and there you go, just under 4,000 of income has been lost. So there's your common sense check as well. Below that you've got the death benefits then projected forward. So looking at the TVC on the right, they've offered a transfer value of 250,000 and the TVC is 383,000. So quite clear visual for the client. You're comparing a big number against a big number, not a big number, they're offering me 250 and my pension's only worth 8 grand, because they're comparing a big number against a small number. So the idea of the TVC here is working. Like you can say, well, you might think your pension's 8 grand, but that's a year revalued, and to buy those benefits 383,000. Critical yield here, it's not actually required as part of COBS, but a lot of advisors understand critical yield, so we thought we'd include it. But we've also added what that critical yield means and how we've got to that. So under the new COBS rules, you have to assume a 0.75% annual management charge and a one-off 4% annuity charge. So we've factored that in. And the critical yield is not to grow from the blue box to the orange box. It's actually to grow from the blue box, which is the CETV, to the capitalized amount at normal retirement date. Capitalized value there, look. And the capitalized value is the total pot required to purchase the annuity prior to discounting back to the TVC. 7.23. And what should happen with the TVC? It should be completely impersonal. So there's no real personalization on that, whether the client's single or married, or if it's a male and his wife is older than him. We don't do any, the TVC doesn't take any of that. It's completely impersonal. What we've then done in addition to that, we've then said, well, the client wanted to retire at 60, so let's actually give a TVC for 60 as well, and a critical yield for 60. We just thought it was fairly useful. And then got a PPF. We've also provided a TVC for PPF as well. Many clients think going into the PPF is the end of the world and it's horrific and they're going to lose out massively. But this would quite clearly show the client that the benefits provided under the PPF would still cost $324,000. So, you know, that potentially could reassure the client that actually the PPF is not the end of the world. It's quite a good and sensible option if they think insolvency of the scheme and the employers on the cards. What you can do then is you can create a TVC report, and you can produce one either a Word report, or I'm going to produce a PDF. But if you wanted to change some of the compliance wording, you could, or if you wanted to put your own index in there, you can just do the Word report version. What we've then done on the assumptions page, we've tried to make it a little bit informative rather than just give you some assumptions. So instead of giving you the normal annuity rate, we've also given you the RPI annuity rate, which has been calculated in accordance with COBS from the rolling 3-month average. Then the level annuity rate, which is that calculation in COBS plus 3.5%, which is where you get plus 1.3. And then the discount rate, and explain that, and that's got to be a risk-free rate of return depending on the time to retirement. So, and that could change. There's the product charge and annuity charge below. Then some simple inputs, so the client hopefully will be able to look at this. It's not a complicated report. It does what it says on the tin. Then when you've got a page of figures, you know, in tranches, you know, we put just, it's a simple thing, but we put bold lines around the important bits, which is there's your benefits at date of leaving, there's your death benefits then at date of leaving. Then the next page of those revalued benefits, again we've just drawn the client and advisor's eyes to the important bits, the totaled up bits. And then we're into the TVC, and that's exactly what you just saw on the screen. What we've then done is put the critical yield below it with an explanation as well, because you might be sitting with a client and the client might say, you know, what does that mean? And of course the client may then say, how do you get to that figure? And there's a nice simple calculation process to go through there. So what we're saying is there's the benefits, then they're capitalized, then there's a one-off annuity charge, then it's discounted back by 1.3% in this case, because that's the risk-free rate of return to retirement. But then of course 0.5% annual charge has gone on there, so it's not even 1.3% growth rate. You know, you're down at, you know, 0.65%, and that's what gives you the TVC. Next page then is exactly the same but for 60, and of course now the discounting rate, because there's 5 years less to retirement and the gilt returns are even lower, so now your discounting rate is 0.95. By the time you take the 0.75 off, you're only looking at a growth rate of 0.2%. So as you can see, the farther away you get from retirement, the bigger the disparity between the CTV and the TVC will become. There's some notes there for the FCA, and then we've just moved into the pension protection fund. Exactly the same, and then the discount rate is back to 1.3% because it's back to normal retirement age of 65. We've deliberately used different colors there for the PPF, so you know you don't get confused with your standard TVCs. And that's pretty much the TVC and TVC report in a nutshell. Hopefully we've made it very, very simple and easy for you to understand and for you to follow. What we will be doing in the future, we haven't done it yet because we were under significant time constraints to get out for the 1st of October, but we are planning on doing an export facility. So if any of our TVC users prefer to use their own cash flow modeling system, or even one of our competitors, I've got no problem with that. You know, I want advisors to use a system they're comfortable with, so we're going to make this TVC data available for you to use in an alternative system. So that's under construction at the moment. We'll get back to you on that. So having built the TVC, we want to now make a seamless transition to APTA. So I'm just going to click the button now. Let's go to the APTA. There's a quick start guide there to help you if this is the first time you've done an APTA. But if you've not printed that off and you just want to work on screen, we've got some help tool tips which pop up there. So for example, inflation, this must be set at 2.5%, and this is mandated in COBS 19 Annex 4C. So what we're trying to do at the tool tips is to show you some of these things. The next one is the growth rate, and as you can see in that explanation there, the FCA initially proposed in their consultation document to mandate that you use the intermediate growth rate from the illustration, but actually when the policy statement came out, they said you can use whatever rate you want, but if you deviate from the illustration, you just have to explain why. So in general, it's going to be around about the intermediate growth rate on the illustration. Then you've got your future incomes and expenditures. And charges are now mandated. Many people who did cash flow planning may have said, well, I'm not going to break down all the charges, I'll just put the return net of charges. So let's say, for example, I'm going to put 4% return and that's net of charges. Under APTA, you should be declaring all of those charges. So if you follow our breadcrumb process and just click next, this is the fact find that the client has done themselves. So you could say, well, I'm happy with that. I'm going to import that data. So you've got all the pre-retirement data there and all the post-retirement data there. And they've got their investments and their separate pensions there. So you could either uncheck them all and just import what you want to one, or check them all and bring them all in. So I've imported the data in. So for the moment I'm going to set the intermediate growth rate, and let's say that's 5%. There's the inflation rate again, as a reminder, has been set. Forecast is set to age 100. Now what COBS says is that you have to pick an end age which is beyond normal life expectancy. So at this stage we're just saying, well, why don't you set it to 100? You can always change it later, but at least we know that we're going beyond the rules of COBS there. There's an option to say, do the client get the full state pension? If they don't, you can get the set pension amount there. So we're just saying they're going to get the full state pension. And then you can add your charges. So there's a platform charge of 0.3 and a fund charge of, let's say, 0.65. Advisor charge is 2%, and then the ongoing charge actually is a fixed amount, and you might charge, you know, £1,500 per year. So rather than a percentage charge. Then just following again through the breadcrumbs, you move from assumptions to savings pot. So it's brought the savings pot through that the clients entered in, and as the High Street Building Society, we've defaulted at the moment 0% return. This is to force you as advisors to say, well, you know, that will be getting, let's say, 1%. This could be from your conversation with the client. And this one here, looking at their funds they're invested in, you might say, oh, that's a 4% return there. We could go and edit that if you wanted to and say, well, you know, if the clients are going to be drawing not in retirement automatically, they're going to be a basic rate taxpayer. And then the final one is the CETV, which has been imported in, and this one can't be amended here because it's a figure, it's brought in from the TVC and also the growth rate there has been brought in from the earlier stage of APTA. Next stage now, this is coming from the client's fact find. So their salary is £2,000 per month, keeping pace with inflation, and that's going to end at their retirement age. And then you've got this pension again has been brought in by the TVC. So there's the revalued figure at age 65, and if you just look on the right hand side, age 60, there's the early retirement figures there. We haven't included the PCLS at this stage here, but there's your figures brought in. And as you can see on the right hand side, because the normal retirement date is 65, that is the income not in today's terms, that's in future terms. And as you can see there's the inflation rate applicable to this, to 3 decimal places, 1.922, because that's the exact indexation rate for this particular pension. If you remember when we did the inputs earlier, some of the benefits were pre-97 and they were no inflation increases, and then some of the others were CPI, which is 2%, so the overall average across all the tranches was just under 2%. So that's a real personalized rate of indexation on this DB scheme. Again, following it through, there's all the expenses we got pre and post. Click in next. This is the opportunity to add a contribution. Could be they're making an employer contribution into a personal pension separately or something, and you could just add that on. For ease, I'm going to say there's no other ones at the moment. Withdrawals again would be from a savings pot or pension. They might already be taken. And then the next page is your charges and fees, which you've already put in just to confirm which ones they are. And then finally, you just pick next and generate the forecast. So it's taken, right, which forecast do you want to generate? So as you can see, we've set to generate 2 at the moment, which is to stay in the scheme versus transfer. So there's 2 options. You could say, I also want to look at taking the PCLS. So stay and go, taking the PCLS, so we never got 4. And actually, if you wanted to do this at both early retirement and normal retirement, you click that, and we'd be generating 8 forecasts. So for ease at the moment, I'm just going to generate 4 of them, and let's just generate the forecasts. And there you go. Top left hand side, your current situation, which is staying in the DB scheme, retire at 65, and there's the alternative on the right of it, transfer your pension, retire at 65. And then the next one down, current situation, retire at 65 and take a PCLS from the scheme, or transfer and take max PCLS. And as you can see, in all of these cases, the clients don't run out of money in either example. And if you click on money in versus money out, there's the expenditure line pre and post retirement, and the blue bars there are the salary, there's the employer's pension, and there's the state pension. And over on the right hand side now, there's only one fixed income in retirement, which is the state pension, because of course they've transferred their DB scheme into a DC. What you can do once you've got this, you can say, well, I now want to go and personalize even more. So let's go to the cash flow modeler, and there's everything we brought in, the inflation and retirement age of 65. If we go down to the cash flow model, you can see this client here doesn't run out of money, and at age 100 have still got 162,000 in their pension. This is where you can actually go now and personalize even more and say what we want to do now is the client wants to do some additional spending to achieve some costed goals, bearing in mind the attitude to transfer risk questionnaire earlier. Or we can just go in and stress test it, and let's have a look at this client's capacity for loss. So I'm going to go click on simulate a market event. We're going to go and look at a stress test of 20% drop. When's this going to happen? Let's say at age 64, just before they're due to retire, and we're going to do this for their transfer value. I'm going to run that simulation, and you can see there's just a straightforward drop of 20%. No recovery, just a drop. So let's apply those changes, what you saw there then is at 64 dropped from 267,000 to 204. That's a significant drop there. So we've tested the client's capacity for loss and they still don't run out of money. What you could do, let's remove that market event if you want to. Go back, remove the market event so it's back to normal. But you might want to go and say, well, that's assuming linear return of 5%. What I actually want to do is go in and look at, edit that, and I want to look at a variable return, and I'm going to look at the balanced, which is actually average 6.53, and the real rate of return above inflation is 4.03, and let's update that pension. Go back to cash flow model, and now what you can see is some definite variable returns there. So you've got subsequencing of risk as well, but again, client doesn't run out of money, and you could then combine that with a stress test. You know, adding in simulate a market event. If you've exposed the client to an equities there, we might say, well, actually I want to look at the stock market crash which happened in 2008, and we're going to apply that again at 64. Run that simulation, and there's a big drop there of nearly 35%. Let's apply that change there, and there you are, big drop, 360,000, 220,000. Okay, no recovery from that. We've just then continued the normal variable returns, but again, the client doesn't run out of money. Some great capacity for loss test in there, and really personalizing your APTA for the client. Once you've done that, let's go and have a look at producing a report. So you can just click on a report. I want to include the TVC scenario for the APTA forecasts in there. For ease now, I'm not going to do the breakdowns. You can do Word or PDF. Again, I'm going to do PDF. And there you go now. Saying which report, which forecasts are in there. Right at the start is the TVC. So there's a repeat of the TVC forecast we did, and once the TVC is finished, it's straight into the APTA cash flows, and there you go. Exactly what we've just seen on the screen is now in the client's report with the yearly breakdowns, etc. So hopefully that's shown you how to use CashCalc to, 1, do your TVC, and then 2, how you can seamlessly go across and produce an APTA compliant process, which you can then go and put your personalization to with regard to the client with their spending, their goals, stress testing, capacity for loss. Hope that was helpful, guys, and if you've got any feedback, just please let us know. Thanks very much.